Viva, viva, viva. It's not a market update. I'm just gonna go over a couple of things just to get you guys in a good spirit for the weekend, for the week. It's been a while since the market's been down. We got small rallies, so get us alleviate for a bit. But I want to go over a few, not something extraordinary, but something that you can relate to it, that you can kind of see. There's always a light on the tunnel. Here's an example of the bear market. We looking at the bear market that started 2012. The market has dropped 20%. This is the stock market. And then we're gonna go over it and kind of compare how far the stock market has dropped right now, as we speak right now. So as you can see, that's not 2012. I'm sorry. We talked about the pandemic. This is the drop that we got from the pandemic, which was March 2020. And then dropped 20% decline. So let's go to the trading view. And we'll see. I already prepared that for you guys. You know how it is. They're way faster than you guys. All right, so let's see here how far as the market dropped. We measure from the top to the bottom right now. So right now, as you can see, the stock market has dropped 24.50% in 42 days, right? So 24%. So it has dropped a lot, way further than the 2020. All right, so let's go back to our article here. So now I want you guys to see the bear market so far has been pretty bad. There's so many factors that it's making the bear market being that, and there's more heat coming. There's more heat wave coming in. Just be prepared. Just sometimes you gotta maybe just take a sit and then get better the things that you were weak in the past bull market. So I'm gonna keep saying, go and become a master. Study, do your research, and just get better, man. Just get better, guys and girls. All right, so what are the different types of bear market? Cyclical bear market set off by rising interest rate and high inflation rates at the end of the business cycle. That's what we have right now, as you know. The Feds are raising rates. We got high inflation rates, and this inflation is going to turn into deflation. It's going to be, this bear market is a mix of bad news with bad management. Everything bad is just in one bear market. That's what we have in right now. So structural bear market occurs when a financial bubble or other economic imbalance collapse. Example, the global financial crisis. This is happening in a bear market. In the crypto market, we've seen a couple of great companies. I wouldn't say great company, but good companies that were making money in the bull market, but they weren't so great to survive in a bear market. So we've seen a couple bubbles with, the whole crypto market was a huge bubble. And within this bubble, there were small bubbles, especially on the DeFi. There's so many people that open up businesses without structure within the crypto market. And we're seeing this small bubbles just popping. So that's what we're saying. This bear market is so important. At the same time, it's so bad because there's so many things within this bear market that is collapsing. It's going to make it way worse than maybe 1929, the Great Depression. We might not even go to that levels. And then we have the event-driven. As the name suggests, an event-driven bear market is caused by a specific or significant event Example, the pandemic. All right. I'm not gonna go over the bear market versus the bull market. That's not what what I wanted to show you guys is this. There's a different types of bear market. So you guys now understand why certain bear markets are worse than other bear markets, because there's different bear markets. There's different bear market. But I believe this one is a combination of these three, these three bear markets. This is why it's being pretty bad. So we'll survive. We'll survive. It's sad that many countries are collapsing right now. The media is not really focused on that. You know, I'm surprised they actually mentioned Sri Lanka. What's going on in Sri Lanka? But we got Argentina is on the verge of collapsing. Zimbabwe went collapsing. Not a lot of people knew because, you know, maybe because it's Africa. So we got European. For those who don't know what PIGS is, those are the countries that actually they have the most debt in the European Union. It's called PIGS, which is P for Portugal, E for Italy, and then there's another E. I forgot what that is, what country it is. And G, which is Greece, and S, I think S is what? Spain, I think that's Spain. Those are the countries that have the most debt. They're in the verge of collapsing as well. So for those that invest in Europe, it's do your research because they're in a very critical cycle right now. The inflation is way high. It's kind of sucks because the inflation for the European Union, brings everybody. Everybody will pay for it, for all this printing and all this stuff. So for those that invest in Europe, be careful, especially with the countries within European Union, which they call PIGS, and they in a very, very bad shape. And if you invest in there right now, be careful when and how and what you're investing, because you might find yourself within this big mess. All right, so now we're gonna take a look at this quote from Muhammad Ali that says, "I hated every minute of training, but I said, don't quit, suffer now, and live the rest of your life as a champion." So guys, this is some bad news right now. Most of us lost money. Most of us are in a very bad mood, you know, not making money. We're seeing our investors just going down. But guys, this is a price that we pay to later on. If you have a plan, if you do your DCA and know where to invest, at the end of the day, you know, you'll come up as champ. Come up with champion, guys. All right, so now I just want to go over a few people here that made a lot of money within the Great Depression. One of them was the Kennedys. You just go for what he actually did with his father. Right here, he actually made his money while the market was crashing, 1929 in the Great Depression. But Kennedy, which is the father of the President Kennedy, he actually made money shorting the market. What he did was, while most investors watched their fortune evaporate during the 1920 stock market crash, Kennedy emerged from the wealthier than ever. Believing Wall Street to be overvalued, he sold most of his stock holdings before the crash. It made even more money by selling short, betting on stock prices to fall. So, you know, for you to do that, sometimes you need to get some inside information, or when you do your research, you really analyze the market, learn how to analyze. And when you see that the market is overpriced, you will get out. I almost got caught up on Luna. I didn't lose money on Luna. You know, because it's something that I noticed. But that's the thing. I lost money in different companies actually that went bust. But Luna, something told me just to sell it, and I sold it, my stuff that was in the Luna. So yeah, that's the thing. Not everything we're gonna get it right, but this is one of the things. Even on the worst of the worst, people still make money. You just gotta know where to look, how to look, and when to get him back. Because you see what he did, he sold all his stock holdings way before the market crashed because he saw that the market was overvalued and probably saw other signals, other indicators, and then he got out. And then as soon as he got out, he short the market before the crash. He made even more money by selling short because he short the market, which is betting against the stock price that will fall, right? So another one, we got J. Paul Getty. So he made money on the Great Depression through the oil stocks and real estate. See, we can take a look what he did. But oil tycoon J. Paul Getty, that was simple business for him. Buy it when everyone else is selling and hold until everyone else is buying. So this is a very simple way. If you don't want to do a lot of research, you don't want to script in your mind with so many information that there's so many videos, there's so many books to read, all that stuff. You can adapt what the oil tycoon J. Paul Getty did. Buy when everyone else is selling. Buy when everyone else is selling, which means that's when crashes come, when crash is happening, when something's crashing, that's when you buy. And hold until everybody else is buying. So when, in simple words, when everybody's forming in the market, that's when you sell. Having already made his first $1 million in the oil industry more than a decade earlier, Getty skipped a celebration of his parents' golden wedding anniversary during the 1929 stock market crash to commensurate with the Wall Street broker, investor, and speculator. All right, so another one, we got Mae West, movie son. Okay. Paramount Studio, which was teetering on the edge of bankruptcy, signed the West to star in the 1933 film She Done Him Wrong, an adaptation to her hit Broadway play Diamond Lid. The move success changed the Paramount fortunes as well as the West. By the mid-1930s, she earned $300,000 per role and $100,000 per screenplay, making her Hollywood high-paid entertainer and the country's highest-paid woman. West, strong female lead, blah, 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 blah. So it's just another industry. You just got to understand, even the worst of the worst is happening in the market. Every industry can be a blessing to you. You just got to know when to look, how to look, right? So we got Charles Clinton started here, the insurance, you see. And then we got Michael Golan, grocery, food. We got Howard, oil, aviation, movies. And that's pretty much it, guys. All right, so now let's kind of take a investor lesson from the Great Depression. Let's see here, guys. Here's thought. The rules of conservation investment apply whether you buy real estate or stocks or bonds. Throughout the investigation, the first necessary is safety, the principle. And it usually follows that only a fair return on investment can be expected. To seek a high unusual return means greater risk in speculation. That's pretty much what happened in the crypto market. We all been looking for a high return, and you know what happened. People start foaming in, and they just went to the moon. It went to the bottom, actually. All right, so the first one, The three big things of Roth diary stood out. First, one thing that Roth repeated over and over was the lack of cash to buy bargain stocks. Nobody had money. The combination of 90% of the market declined. Yeah, back in 1929, the market actually it kind of collapsed to 90%. Market declines, widespread bank failure, destroy people's savings. So yeah, the other things that is happening right now in a slow motion, but it's happening right now. There's a lot of bank failing. There's a lot of bank closing. System might close. The banks might close. People that have money in the bank, they might lose all their money. So yeah, it gets bad, and that's what he's saying right now. There's the lack of cash to buy bargain stocks. So there was, you know, you didn't have enough cash, enough money to buy those great deals. Even the banks that didn't fail basically froze the customer savings account. You see, the banks that survived, they didn't allow you to take your money, so you wouldn't be able to buy those stocks, those bargains, those cheap stocks, to get you those life savings return. Limit order said how much money a customer could withdraw in a day. We kind of have that here. And in some case, it was as low as 5% of the money in their account. Things got so bad that people saw their passbooks record of their bank account at 50% or left to the amount of their account just to get cash. It wasn't a rare occurrence either. Prices of passbook were quoted daily in the newspaper. So skip that. We're going to the second one now. Second, some people failed to learn from the 29 crash. Several times, Roth told story of people he knew who lost everything in the 1929 crash, only to repeat the same mistakes again for 4 or 5 years later. They likely bought stocks near the lowest of the Great Depression, rode the recovery, it made another small fortune. But rather than sell or leave it alone, they got greedy. They maxed out their account on a margin to buy more stocks, only to watch the market to turn and got wiped out again. The power of desperation and greed over investment decision is hard to overcome. So, and this is the second lesson. You know, a lot of people bought the stock on the near bottom of the stock market. They wrote, you know, they kind of sit back and see the recovery of the market. Instead of taking that, they made a fortune. They made a small, medium fortune. Instead of taking the returns that they got, no, what they did is they got greedy. And they went play the whole stock market thing. They went to get leverage, so they can multiply what they make. Yes, leverage. It's a very very bad gaming, man. If you don't know how to play, it's not a place for everybody to go in and play. Finally, throughout his journey, Roth worked out a sound investment theory over that period. He laid the bucket over the span of 6 years, 1931 to 1937. He figured out early on that market moves in cycles. While he failed to see the difficulty in the market timing early on, he realized the importance of capital preservation. Capital preservation, guys, which is pretty much having your have a percentage of your money saved somewhere. You know, currency, which is money that you use to trade, it loses money a lot fast. Other currencies lose money faster than the dollar. So you gotta have a small portion somewhere. Either you put in precious matter, or you put in the currency more that you believe is the strongest. It will be the last one to fall. That way you have some cash to invest. Not financial advice, right? You start saying that's something that I might do myself. Not do it myself. Actually, I did it. Diversification during severe drawdown, buying bargains at the bottom of the cycle. He was quick to see the dangers of speculation and leverage. Speculation and leverage, guys. More so, he realized that impact behavior play on return. Here are his thoughts. I'm not going to read the whole thoughts. You're going to have that on a link below the video so you can read the whole thing, take some notes. Guys, there's some great lessons from one of the worst stock market, one of the worst economic crashes that we had. All right, so let's look at what Warren Buffett and Jack Boland and financial planners agree. When stocks are down, don't watch the market closely. All right, guys, don't watch because some of you might just get sick or even collapse. So, yeah, wow. Tell me about it. All right, so this is pretty much it. I just wanted to close with that. It's just when things are down, don't watch too close the market. Just do your analysis. If you have a plan, follow your plan, but don't glue yourself into the market unless you're a trader, right? If you're trading every day, it's different. But if you're just an investor, you might get really discouraged and you might not believe that the market might come back. So just stay up, guys. Stay up. All right, so this is it, guys. It's just a quick thing for you guys to actually, that's the marinate within this info. And just knowing that, this happened before. It happened before. And things, it's cycles, guys. It's like today you're good, tomorrow you're sick. The next day you'll be okay. You're jumping, you're doing whatever you do, and then you get sick again until your last day. It's a cycle, we might be the end of the cycle. It might be the end of the cycle. The market normally has to wash out the garbage, has to really clean it up. Clean what's garbage, clean it up. What's useful will survive, will stay here. And then we're going to start a whole new cycle. And don't expect after the washout or the cleanup, the next year we get a huge bull market. I'm not seeing that. I'm not seeing that play, but I do see a central planners coming up with inserting a lot of capital in the market. And we had this huge rally that might last for a couple of months, and then we just go down again. All right, that's what I'm seeing. That's what I'm planning for. I hope you guys do plan for that, because sometime they will have to stop increasing rates because things are getting really bad. And they're just gonna incentivize the market to just get to stabilize. So in the way they only know how to do it, guys, is just to give free money. All right. I'll see you in the next video, guys. Like, subscribe. Stay up, guys. Stay up.